Stop everything you're doing right now. It's Tuesday, January 20th, 2026, and while you were sleeping, while the world was watching the inauguration ceremony, while every news channel was focused on speeches and parades, something happened that is going to fundamentally change the global balance of power for the next century. And I'm not talking about politics. I'm not talking about domestic policy. I'm talking about a geological discovery that was quietly published 4 days ago that nobody is paying attention to, and it's the reason why silver is sitting at $95 per ounce right now and climbing every single hour. I'm William Lee, and what I'm about to show you is going to connect dots that the mainstream media either doesn't understand or is deliberately ignoring. Because while every late-night comedian has been making jokes about President Trump trying to buy Greenland, while CNN has been running 24-hour coverage of offended Danish politicians, while the entire financial establishment has been treating this as a real estate vanity project, a document was uploaded to the United States Geological Survey website that changes absolutely everything. This is not speculation. This is not conspiracy theory. This is official government data that I'm going to walk you through line by line. And by the time I'm done, you're going to understand exactly why silver is at $95 and heading toward $100, why China just offered Denmark $300 billion, why the Pentagon is holding emergency meetings, and why the global silver market is about to fragment into regional pricing zones with differences of 40% or more. Before I show you the evidence, before I prove to you why this Greenland situation is actually a calculated resource war disguised as a real estate dispute, you need to understand what happened in the physical silver market over the last 72 hours, because the price action you're seeing right now is not normal. This is not a typical rally. This is the beginning of a supply panic driven by strategic competition between superpowers. On Friday, January 17th, 2026, at exactly 4:47 p.m. Eastern Time, the United States Geological Survey uploaded an 89-page technical report titled Revised Mineral Assessment of the Citronen Fjord Polymetallic Deposit, Northern Greenland. I have this document open in front of me right now. It's publicly available. Anyone can download it from the USGS website. But almost nobody has read it, and the ones who have read it are not talking about it publicly because they're too busy positioning themselves before the rest of the world wakes up. Let me read you the exact text from page 47 of this report. This is official United States government geological data. Updated core sample analysis utilizing advanced spectroscopy techniques indicates previously undetected silver concentrations in the Citronen Formation averaging 847 grams per ton across an estimated 2.4 billion ton ore body. This represents a potential in situ resource of approximately 2.03 billion troy ounces of silver with a high degree of confidence based on 127 drill core samples analyzed between June and October 2025. Let me say that again so it sinks in. 2.03 billion troy ounces of silver in a single deposit in Greenland at an average grade of 847 grams per ton. Now, if you're not familiar with mining economics, let me put those numbers in perspective for you. Total global silver mine production in 2025 was approximately 830 million ounces. This one deposit in Greenland contains enough silver to supply the entire world for 2.5 years. The largest currently operating silver mine on Earth is Cannington in Australia, which produces about 18 million ounces per year. The Citronen Fjord deposit is 113 times larger than Cannington. But here's what makes this absolutely extraordinary. The grade. 847 grams per ton is not just good, it's exceptional. Most silver mines operating today are profitable at grades between 150 and 300 grams per ton. First Majestic Silver operates multiple mines in Mexico at average grades of 200 to 350 grams per ton, and they're highly profitable at current silver prices. The Citronen deposit is 2 to 4 times higher grade than those operations. What does that mean economically? It means that even with the enormous logistical challenges of operating in the Arctic, even with the extreme costs of building infrastructure 780 miles from the North Pole, this deposit would be extraordinarily profitable at any silver price above $40 per ounce. We're currently at $95. This mine, if developed, would print money. Now let me show you the timeline, because this is where the strategic coordination becomes undeniable. The drill core samples were collected between June and October 2025. That's 6 to 9 months ago. The analysis was completed in November 2025. That's 3 months ago. The data has been sitting in USGS files for at least 3 months, and it gets published on Friday, January 17th, 2026, the exact same week that President Trump announces his renewed push to acquire Greenland and implements a 10% tariff on 8 European nations, including Denmark, with the explicit threat of escalation to 25% if a Greenland deal is not reached. You think that's a coincidence? This is coordinated geopolitical strategy operating at the highest levels. The Trump administration has known about this deposit for months. The timing of the data release, the timing of the Greenland announcement, the timing of the tariffs on Denmark, this is a multidimensional pressure campaign designed to accomplish several objectives simultaneously. First, it justifies the Greenland acquisition to the American people and to Congress. Most Americans think Greenland is just ice and polar bears. But when you show them 2.03 billion ounces of silver, one of the most critical strategic minerals for solar panels, electric vehicles, 5G infrastructure, missile guidance systems, and advanced electronics, suddenly the purchase makes sense. This isn't ego. This isn't a vanity project. This is national security. Second, it applies maximum economic pressure on Denmark. The 10% tariff, escalating to 25%, hits Danish exports hard. Denmark's economy is highly dependent on trade with the United States. By tying the removal of those tariffs to progress on Greenland negotiations, the administration has created enormous economic incentive for Denmark to come to the table. Third, and this is the most important part, it forces China to show their hand. And boy, did they show their hand fast. Within 24 hours of the USGS report being published, the Chinese Ministry of Natural Resources held a closed-door emergency meeting in Beijing. I have contacts in the Chinese mining industry who confirmed that this meeting included executives from China Minmetals, the largest state-owned mining conglomerate, Zijin Mining Group, one of China's largest gold and copper producers that's been expanding into silver, and representatives from the People's Liberation Army Strategic Support Force, which is the military division responsible for securing critical resources for national defense. The topic of that emergency meeting was the Greenland silver deposit and how to prevent exclusive U.S. control. And within 48 hours, the Chinese government made their move. On Saturday, January 18th, Chinese state media published an op-ed in the Global Times titled "Arctic Resources Belong to Humanity, Not Hegemons." Let me read you the key passage. As climate change opens new frontiers in the Arctic, certain nations are attempting to monopolize strategic resources under the guise of sovereignty and security. The international community must ensure that Arctic mineral wealth serves all of humanity, not the narrow interests of declining empires. The article never explicitly mentions the United States, Greenland, or silver, but the timing, the language, the geopolitical context makes it crystal clear. This is China signaling to the world that they will contest any U.S. monopoly over Greenland's resources. This is economic warfare disguised as humanitarian principle. And then, on Sunday morning, the Financial Times ran a story citing anonymous sources close to the Chinese government that China is preparing a $300 billion infrastructure investment package for Denmark and Greenland. Let me repeat that number, $300 billion. To put that in perspective, Denmark's entire GDP is approximately $400 billion. Greenland's GDP is less than $3 billion. China is offering more than 100 times Greenland's annual economic output. What does $300 billion buy? According to the leaked details, China is offering to build a deep-water port capable of handling container ships and bulk carriers, an international airport with runways long enough for wide-body jets and cargo aircraft, fiber-optic cable infrastructure linking Greenland to North America and Europe, roads connecting all major settlements, a renewable power grid using hydroelectric and wind, complete 5G and 6G telecommunications infrastructure, subsidized housing and public services for Greenlandic residents, and educational and healthcare facilities. In exchange, China wants cooperative mineral development rights, which is diplomatic code for exclusive or heavily preferential access to Greenland's silver, rare earths, uranium, and zinc deposits. This is a geopolitical counteroffensive at a scale that hasn't been seen since the Cold War. China is attempting to outbid the United States for control of one of the most strategic mineral deposits on the planet. And the United States responded immediately. On Sunday night, the White House convened an emergency National Security Council meeting. By Monday morning, leaks appeared in the Wall Street Journal reporting that the Trump administration is preparing a counteroffer that includes $150 billion in infrastructure investment, military protection guarantees including expanded U.S. presence at Thule Air Base, an integration of Greenland into U.S. missile defense systems, a pathway to Greenlandic independence with full U.S. diplomatic and economic support, and exclusive U.S. mineral development rights for 50 years. Now, you might look at those numbers and think China's offer is better because it's twice as much money. But here's the trap that Greenland faces. Greenland doesn't trust China. Greenland has a population of about 56,000 people, mostly Inuit indigenous communities. These communities have been pushing for independence from Denmark for decades, but they're extremely wary of becoming economically colonized by China. They've watched what happened in Africa, where Chinese infrastructure projects came with massive debt obligations and exploitative mining agreements that left local populations impoverished, while Chinese state-owned companies extracted billions in resources. They've seen Sri Lanka lose control of the Hambantota port when they couldn't repay Chinese loans. They've seen what happens when you accept Chinese money without understanding the strings attached. The United States, despite all its faults, is a known quantity. Greenland has had a relationship with the US through Thule Air Base since 1943. There's cultural affinity, there's historical precedent, and critically, if Greenland aligns with the United States, they get military protection. If they align with China, they risk sanctions from NATO, from the European Union, and from the United States itself. Greenland is caught in the middle of a superpower bidding war, and their choice is going to determine the balance of power in the Arctic for the next century. But more importantly for you and me, their choice is going to determine who controls 20% to 25% of future global silver supply. Now let me show you what this means for the silver price, because this is where theory becomes reality. Right now, as I'm recording this on January 20th, 2026, silver is trading at $95 per ounce on the COMEX. But that number is increasingly meaningless. It's a paper price based on futures contracts where only about 2% result in actual physical delivery and the rest are cash settled. The real price, the price you actually have to pay to get physical silver in your hands, is significantly higher, and the divergence is widening every single day. Let me give you the actual numbers from dealers I contacted yesterday. American Silver Eagles at APMEX, $113.47 per coin. That's an $18.47 premium over spot, which works out to a 19.5% premium. Canadian Maple Leafs at JM Bullion, $110.23s. That's a $15.23 premium, a 16% premium. Generic silver rounds, which are typically the cheapest option, $103 to $106. That's an $8 to $11 premium over spot. These are not normal premiums. In a healthy liquid silver market, premiums on generic rounds should be $2 to $3. Premiums on government coins like Eagles and Maples should be $4 to $6. Right now, we're seeing premiums that are 2 to 3 times normal levels. The physical market is tight. Dealers are struggling to get inventory. Wait times have extended from 1 to 2 weeks to 4 to 6 weeks for some products. People are paying massive premiums because they can't get metal anywhere else. But here's where it gets absolutely insane. And this is information I got from a contact who works in Arctic logistics. He deals with shipping for mining operations in northern Canada, Alaska, and Greenland. And he told me yesterday that private commodity traders and mining companies are quoting physical silver for delivery to Arctic ports, specifically Greenland, northern Norway, and the Canadian Arctic, at $137 per ounce. $137 per ounce. While your screen shows 95s on the COMEX, that's a $42 premium over the official spot price. That's a 44% premium. When I asked him why anyone would pay $137 when the official price is $95, he said something that perfectly captures what's happening. In the Arctic, silver is not a commodity. It's a strategic resource. And if you want to lock up supply before the US or China control the entire region, you pay whatever it takes. This is the complete breakdown of what economists call the law of one price, which states that in an efficient market, identical goods should trade at the same price everywhere after adjusting for transportation costs. But look at what we're actually seeing in the global silver market right now. Silver in New York, COMEX paper, $95. Silver in New York, physical retail, $105 to $113s. Silver in London, LBMA paper, $94. Silver in London, physical allocated, $108. Silver in Shanghai, international, 93. Silver in Shanghai, domestic Chinese, 107s. Silver in the Arctic, physical contracts, 137. These aren't small variations. These aren't minor discrepancies caused by shipping costs. These are massive dislocations representing a 15% to 44% range in what's supposed to be a globally traded commodity. The silver market is fragmenting into regional pricing zones based on access, logistics, and geopolitical control, and that fragmentation is accelerating because of the Greenland situation. Now let me walk you through the mathematics of why the Citronen Fjord deposit matters so much. First, let's look at the basic economics. The deposit is located in northern Greenland at 82 degrees north latitude. To put that in perspective, the North Pole is at 90 degrees north. This deposit is only 780 miles from the North Pole. It's one of the most remote, inhospitable locations on Earth for mining operations. The estimated resource is 2.03 billion ounces of silver contained in 2.4 billion tons of rock. The average grade is 847 grams per ton. The ore body also contains significant zinc as a co-product, approximately 4.2 million tons, which improves the economics because you can sell both metals. The deposit ranges from 200 to 800 meters below the surface, which is relatively shallow and means it could potentially be developed as an open pit operation rather than an underground mine, which is much cheaper. Let's run the profit math. At the current price of $95 per ounce, and assuming all-in sustaining costs of $55 per ounce, which is high but reasonable given Arctic logistics, the profit margin is $40 per ounce. $95 minus $55 equals $40. Multiply that by 2.03 billion ounces, and you get $81.2 billion in lifetime profit. But I don't think silver stays at $95. I think we're heading to $120 to $130 within the next 6 months based on the supply deficit and the geopolitical competition. At $120 silver, with the same cost structure, profit margin goes to $65 per ounce. $120 minus 55 equals $65. Multiply that by 2.03 billion ounces, and you get $131.95 billion in lifetime profit. This is not a marginal mining project. This is one of the most valuable, undeveloped mineral assets on the planet. And whoever controls it doesn't just control profit, they control strategic leverage over a significant portion of future global silver supply. And here's why that leverage matters more than the profit. The world is facing a structural silver deficit that's only going to get worse. Let me show you the supply-demand fundamentals that nobody in the mainstream media is talking about. Global silver demand in 2025 was approximately 1.1 billion ounces, broken down as follows: industrial demand for electronics, solar panels, electric vehicles, medical devices, and water purification, 550 million ounces; investment demand for coins, bars, and ETFs, 250 million ounces; jewelry and silverware, 200 million ounces; photography and other uses, 100 million ounces; total demand, 1.1 billion ounces. Now let's look at supply. Global silver supply in 2025 was approximately 1.05 billion ounces, broken down as follows: mine production extracted directly from the ground, 830 million ounces; recycling recovered from electronics and industrial waste, 180 million ounces; government sales from strategic stockpiles, 40 million ounces. Total supply, 1.05 billion ounces. Do you see the problem? Demand is 1.1 billion ounces. Supply is 1.05 billion ounces. That's a 50 million ounce annual deficit, and that deficit is being filled by draining above-ground inventories, COMEX registered vaults, LBMA allocated accounts, government stockpiles, and ETF holdings. But those inventories are running dry. COMEX registered silver, which is the metal available for immediate delivery against futures contracts, has dropped from 140 million ounces in 2020 to just 58 million ounces today. That's a 59% decline in 5 years. LBMA vaults have been drained by massive Asian demand, particularly from India and China. The U.S. strategic stockpile has been drawn down to just 8 million ounces after Treasury sales. And here's the critical point. Demand is not staying flat. It's accelerating dramatically. By 2030, according to projections from the Silver Institute and major commodity research firms, global silver demand will hit 1.5 billion ounces per year. Why the massive increase? Solar panel installations are tripling from 200 gigawatts of new capacity annually to 600 gigawatts annually as countries race to meet renewable energy targets. Each gigawatt of solar capacity requires approximately 500,000 ounces of silver. That means solar alone will add 100 million ounces of new annual demand by 2030. Electric vehicle production is growing from 15 million units in 2025 to a projected 50 million units by 2030. Each EV uses about 1 ounce of silver in various electrical components, contactors, and battery management systems. That's another 35 to 40 million ounces of new demand. 5G and 6G telecommunications infrastructure expansion, particularly in developing countries, will add another 30 to 40 million ounces of demand as new cell towers, base stations, and network equipment get installed. Total projected demand by 2030, 1.5 billion ounces. Now let's look at projected supply. Mine production from existing operations is actually declining because many large silver mines are depleting. Existing mines will produce maybe 750 to 800 million ounces by 2030. Recycling might increase to 200 million ounces as higher prices make recovery more economical. Government sales will be negligible because most strategic stockpiles are already depleted. Total projected supply by 2030, 950 million to 1 billion ounces. Demand, 1.5 billion ounces. Supply, 1 billion ounces. That's a 500 million ounce annual deficit. You cannot fill a 500 million ounce deficit by draining inventories because there won't be any inventories left. You cannot fill it by increasing recycling because recycling is already near maximum efficiency. The only way to fill that deficit is new mine production, and there is only one mine project large enough to make a meaningful dent in that deficit, Citronen Fjord in Greenland. At peak production, which would be 10 to 12 years from now after construction and ramp up, this mine could produce 60 to 80 million ounces per year. That's 12% to 16% of the projected 500 million ounce deficit. It doesn't solve the problem entirely, but it's the single largest potential new source of silver supply in the world. And whoever controls it gets to decide which countries and which industries get access to that silver. If the United States controls Greenland, we prioritize American solar manufacturers, American EV makers, American defense contractors, and the U.S. Mint. We restrict or prohibit exports to China. We use access to Greenland silver as leverage in trade negotiations. If China controls Greenland, they do the exact same thing to us. They prioritize Chinese industries. They restrict U.S. exports. They create a choke point where American technological development and national defense becomes dependent on Chinese-controlled Arctic silver. That's the strategic reality. That's why this matters. That's why China offered $300 billion within 48 hours of the USGS report being published. Now let me show you what happened in the physical market over the weekend, because this is where the panic is starting to show. I spent hours on Saturday and Sunday calling dealers, checking websites, and talking to industry contacts. And what I found is that the physical silver market is showing signs of genuine stress. Wait times for delivery have extended dramatically. APMEX, one of the largest dealers in the United States, is now quoting 4 to 6 weeks for delivery on most products. JM Bullion is at 3 to 5 weeks. SD Bullion is at 4 weeks minimum. These dealers normally fulfill orders within 1 to 2 weeks. The fact that wait times have doubled or tripled indicates that they're having trouble sourcing inventory from wholesalers and refiners. Premiums are widening across the board. 3 weeks ago, generic silver rounds were available at $3 to $4 over spot. Now they're $8 to $11 over spot. American Eagles were $6 to $7 over spot 3 weeks ago. Now they're $18 to $19 over spot. These premium increases have happened in less than a month. Product availability is declining. Several dealers have removed certain products from their websites entirely because they can't source them. I checked 5 major dealers yesterday, and 3 of them had out-of-stock or unavailable listings for 100-ounce bars, which are typically one of the most liquid products. And here's the most telling sign. Bid-ask spreads are widening. The bid-ask spread is the difference between what a dealer will pay you for silver and what they'll charge you for silver. In a healthy market, that spread is tight, maybe $1 to $2 per ounce. Right now, I'm seeing spreads of $4 to $6 per ounce, which indicates that dealers are uncertain about their ability to replace inventory and are therefore pricing in risk. All of these signals, extended wait times, rising premiums, declining availability, and widening spreads point to the same conclusion. The physical silver market is tightening. And the Greenland news is accelerating that tightening because it's making people realize that silver is not just a commodity. It's a strategic asset in a geopolitical competition. Now let me talk about the 3 scenarios for how this plays out, because the path we go down is going to determine where silver trades 6 months from now. Scenario 1, the United States wins. In this scenario, the US and Greenland announce a deal. Greenland gains independence with US backing. The US gets exclusive mineral development rights for 50 years. What happens to the silver price? In the short term, COMEX paper silver might actually drop to $88 or $85 as algorithmic traders assume that the announcement of new future supply is bearish, but physical silver stays elevated, probably $105 to $115, because that supply is 10 years away and doesn't solve the current deficit. The real impact is on China. If the U.S. controls Greenland and refuses to allow exports to China, the Chinese domestic silver price spikes to $120, $130, potentially $140 as Chinese solar manufacturers, EV makers, and electronics companies scramble to secure alternative sources. You end up with massive arbitrage where silver is $85 in New York but $140 in Shanghai. Except you can't exploit that arbitrage because the U.S. government won't allow exports to China. Scenario 2, China wins. In this scenario, China and Greenland announce a deal. Greenland becomes independent with Chinese backing and infrastructure investment. China gets preferential mineral development rights. What happens? The Shanghai price stabilizes or even drops slightly because China has secured future supply, but the U.S. domestic price spikes violently. American solar companies, Tesla, defense contractors, suddenly they all realize they're dependent on Chinese-controlled silver. The U.S. price goes to $120, $130, $140 as companies rush to stockpile and lock in long-term contracts before China can implement export restrictions. COMEX becomes irrelevant because nobody trusts paper contracts when physical supply is controlled by a geopolitical rival. Scenario 3, stalemate. In this scenario, which I think is actually the most likely in the short term, neither side wins outright. Greenland remains autonomous. They don't fully commit to either the U.S. or China. They accept investment from both. They maintain control over their own mineral resources and play the two superpowers against each other to maximize their negotiating position. What happens to silver? It goes vertical. because nobody knows who gets future supply. Both the US and China start hoarding physical silver domestically. Both markets see prices of $120, $130, $140 simultaneously. COMEX and LBMA lose all credibility as global price-setting mechanisms. We enter a world of regional markets with wildly different prices and restricted flows between them. My personal belief is that we're in scenario 3 right now. Greenland is not going to make a decision quickly. They're going to drag this out for months, possibly years. They're going to accept infrastructure investment from both sides. They're going to take meetings with both Washington and Beijing, and they're going to use that uncertainty to extract maximum concessions. And that uncertainty is going to drive silver significantly higher over the next 6 to 12 months. Because when you don't know who controls 20% of future supply, when you're a company that needs silver to build your products, you don't wait to find out. You buy now. You stockpile. You lock in supply at any price. Now let me address the enormous logistical challenges of actually developing this mine, because understanding these challenges helps you understand why control matters, even if the mine never gets built. Citronen Fjord is located at 82 degrees north latitude. To put that in perspective, the Diavik diamond mine in Canada, which is one of the most remote mines currently operating, is at 64 degrees north. Citronen is 18 degrees further north. It's 780 miles from the North Pole. Winter temperatures range from 40 to 50 degrees Fahrenheit. Summer temperatures range from 35 to 45 degrees. The ground is permafrost year-round, which means all infrastructure must be built on stilts or special foundations to prevent the heat from buildings from melting the permafrost and causing collapse. At 82 degrees north, the sun doesn't rise for 4 months in winter, from late October to late February. And the sun doesn't set for 4 months in summer. Traditional day shift and night shift work schedules don't apply. You're either working in total 24-hour darkness or total 24-hour daylight. And the fjord is ice-covered 9 to 10 months per year. Ocean shipping is only possible for 2 to 3 months in late summer, July through September. All supplies, equipment, fuel, food, everything must be shipped in during that narrow window and stockpiled for the entire year. Currently, there is no infrastructure near Citronen, no roads, no airport capable of handling large cargo planes, no port, no power generation, no worker housing, no medical facilities. Everything has to be built from scratch. What would be needed? A deep-water port capable of handling 50,000-ton bulk carriers, an airport with a 10,000-foot runway capable of handling 747 cargo freighters, 200 miles of all-weather roads connecting the mine to the port, 500 to 800 megawatts of power generation, probably diesel generators, or possibly a small modular nuclear reactor. Processing facilities for crushing, grinding, flotation, and smelting. Worker camp with housing, dining, medical, and recreational facilities for 2,000 to 3,000 workers. Environmental systems for waste management, water treatment, and tailings storage. Total capital cost, $10 billion to $15 billion. Construction timeline, 7 to 10 years from project approval to first production. And that assumes everything goes smoothly, which it won't. There will be environmental opposition. Greenpeace and the World Wildlife Fund are already mobilizing against this project. They argue that mining will destroy pristine Arctic environment, disrupt caribou migration patterns, pollute rivers, and contribute to climate change. And they have a point. The ecological impact would be significant. But here's the counter-argument. The world has committed to reducing carbon emissions through renewable energy. Solar panels, wind turbines, electric vehicles, battery storage systems, all of these technologies require massive amounts of silver. So we face a choice. Mine Arctic silver and accept the environmental impact, or fail to meet our renewable energy targets and accept runaway climate change. There's no perfect solution, only trade-offs. And whoever controls Greenland gets to make that decision. But even if the mine never gets built, even if environmental opposition delays the project for decades, control still matters enormously. Just the existence of 2.03 billion ounces of potential supply sitting in Greenland and controlled by one country gives that country strategic leverage. They can threaten to develop it. They can use it as a negotiating chip. They can promise access to allies and deny it to rivals. Now let me show you my personal strategy for navigating the next 6 months, because I think we're entering the most volatile and potentially profitable period in the history of the silver market. First, I am holding all of my physical silver with absolutely no intention of selling until we hit $120 to $130. I don't care if we gap up to $100 this week. I don't care if we spike to $110. The metal stays in the safe. Why? Because I understand that what's happening right now is bigger than a short-term price move. This is a fundamental restructuring of the global silver market driven by geopolitical competition for strategic resources. Second, I'm watching silver mining stocks very closely. Specific companies like First Majestic Silver, Hecla Mining, Pan American Silver, Kerr Mining. These stocks closed Friday at levels that imply silver prices of $50 to $60, but physical silver is already trading at $105 to $137 depending on location. That's a massive valuation disconnect. When the market fully prices in the new reality, when investors realize that physical silver is going to trade at sustained premiums of 20% to 40% over paper prices, these mining stocks are going to explode higher. If we see a pullback in mining stocks to levels from 2 weeks ago, I'm buying aggressively because that represents a gift opportunity. Third, I'm allocating 2% to 3% of my portfolio to Arctic exploration junior miners. There are several small companies that have exploration licenses in Greenland for rare earths, uranium, and silver. I'm not going to name specific tickers because this is not financial advice, and I'm not a financial advisor, but with research you can find these companies. If the Citronen discovery gets validated and the US or China commits $10 billion to infrastructure development, every other exploration project in Greenland becomes more valuable because infrastructure can be shared. These are lottery tickets. Most will go to zero, but if one hits or gets acquired, 10x to 50x returns are possible. Fourth, I'm monitoring Greenland negotiations daily. I have Google alerts set up for Greenland mineral rights, China-Denmark investment, Trump-Greenland deal. If the US and Greenland announce a deal, I'm buying more physical silver immediately because it confirms that silver is a strategic national security asset. If China and Greenland announce a deal, I'm buying more mining stocks because it confirms the same thesis from a different angle. My stop-loss scenario: if the US, China, and Denmark agree to some kind of multilateral development where the Citronen deposit is managed by an international consortium and no single country gets exclusive control, that would be bearish. It would reduce the scarcity premium and the geopolitical urgency. In that scenario, I would take profits on trading positions while maintaining my core physical holdings for the long term. My price targets: $120 to $140 within 6 months if the geopolitical competition intensifies. At $120, I'm selling 30% of any trading positions I have in mining stocks. At $130, another 30%. At $140, the rest. But my physical silver, I never plan to sell that. That's wealth preservation for the long term, potentially generational wealth if this situation evolves the way I think it will. Let me give you some historical precedent for why strategic resource competition drives massive price moves. In 1973, we had the Arab oil embargo. OPEC nations cut off oil supplies to the United States in retaliation for U.S. support of Israel in the Yom Kippur War. Oil prices quadrupled from $3 per barrel to $12 per barrel in a matter of months. Gas lines, rationing, economic recession. The embargo lasted until March 1974. The lesson: when countries that control strategic resources weaponize those resources for geopolitical objectives, prices explode and stay elevated until alternative sources are developed, which takes years. In 2010, we had China's rare earth export restrictions. China produces about 90% of the world's rare earth elements, which are critical for electronics, batteries, wind turbines, and military applications. In 2010, China implemented export quotas and restrictions. Prices spiked. Neodymium went up 10x. Dysprosium went up 20x. Western countries panicked. The US, Japan, and Europe filed complaints with the World Trade Organization. They scrambled to restart domestic rare earth mining. Molycorp reopened the Mountain Pass mine in California. Lynas started production in Australia, but it took years and billions of dollars in investment. And even today, China still dominates the rare earth supply chain. The lesson: when a dominant supplier weaponizes a critical material, prices explode and alternatives take years to develop, even when massive capital is deployed. We're seeing the exact same pattern developing with silver in Greenland. Greenland doesn't currently produce any silver, but it has the potential to produce 60 to 80 million ounces per year, which is 7% to 10% of global supply. If the US controls it and restricts exports to China, or if China controls it and restricts exports to the US, we get a bifurcated market with massive price dislocations. The country that loses access scrambles for alternatives in Peru, Bolivia, Chile, Mexico, Poland, and increases domestic Chinese production. But none of those alternatives can make up for losing 60 to 80 million ounces of annual supply. The price in the restricted country goes vertical. Now let me connect this to everything we've been covering over the last 3 weeks, because this Greenland discovery is the 4th warning sign in a systematic breakdown of the global silver market. 3 weeks ago, we warned about the Shanghai premium explosion when physical silver in China hit $13 over COMEX spot. That was the first warning that the Chinese market was decoupling from Western pricing. 2 weeks ago, we exposed the COMEX delivery squeeze when registered inventory dropped below 60 million ounces. That was the second warning that the physical supply available for delivery was running dangerously low. Last week, we revealed the LBMA vault crisis when London couldn't fulfill allocated account withdrawals and had to implement delays and restrictions. That was the third warning that the fractional reserve system in precious metals was starting to crack. And now, today we have the Greenland discovery, the US-China bidding war, and the $137 Arctic premium. That's the fourth warning. All four warnings are saying the exact same thing. The global silver market is breaking down. Physical is decoupling from paper. Regional markets are fragmenting. Strategic competition is replacing free trade, and the price is about to explode. Here's my week-by-week forecast for the next 30 days based on how I think this is going to unfold. Week 1, January 20th to 26th. The USGS report circulates widely on financial Twitter, Zero Hedge, Bloomberg terminals. Traders and analysts realize this is not a joke. Silver gaps from $95 to $100, possibly $103 on Monday morning when markets open. Mining stocks explode. First Majestic, Hecla, Pan American, Coeur, all up 15% to 25% on Monday alone. By midweek, mainstream media catches on. CNBC runs segments on the Greenland discovery. Financial Times publishes detailed analysis. Reuters interviews mining analysts confirming the deposit is real and economically viable. Physical dealers report a surge in buying. Premiums widen from current $8 to $18 levels to $15 to $25 over spot. By Friday, January 24th, silver is trading at $105 to $110. The narrative in financial media is shifting from Trump is crazy to Trump is strategic. Week 2, January 27th to February 2nd, China makes their formal move. The Chinese government officially announces the $300 billion infrastructure investment package for Denmark and Greenland with detailed specifications, ports, airports, roads, power, telecommunications, in exchange for cooperative mineral development rights. Financial media covers this extensively. It's no longer just a commodity story. It's a major geopolitical story about a new Arctic Cold War. Trump responds midweek. The White House announces a U.S. counteroffer, $150 billion military protection, pathway to independence, 50-year exclusive mineral rights. Media frames it as the biggest superpower competition since the space race. Silver breaks through $110, then $115. Physical premiums in the U.S. are now $20 to $30 over spot. Dealers are running low on inventory. Wait times extend from 4 to 6 weeks to 6 to 8 weeks. Mining stocks continue surging. First Majestic hits $25 to $30. Week 3, February 3rd to 9th. Greenland responds. Greenland's parliament holds emergency sessions debating the U.S. offer versus the Chinese offer versus maintaining full autonomy. The sessions are televised. International media is watching closely. Denmark issues a statement asserting that they still have final authority over Greenland's foreign policy and defense and won't allow Greenland to become a pawn in a U.S.-China rivalry. But everyone knows Denmark's statement is weak. Denmark lacks real leverage. Silver hits a peak of 108 tons to 120 toolers on uncertainty. Industrial users panic buy. Tesla, solar manufacturers, defense contractors are all locking in supply before prices go even higher. Physical silver in the U.S. is now trading at $135 to $145, essentially matching the Arctic premium. The premium over COMEX paper has compressed because nobody trusts paper anymore. Everyone wants physical. COMEX registered inventory drops below 50 million ounces. Rumors circulate that the exchange might implement emergency measures, position limits, margin requirement increases, incentives for cash settlement instead of physical delivery. Week 4, February 10th to 16th, resolution or continued stalemate. If Greenland announces alignment with the U.S., Chinese silver spikes to $145 to $165 as China scrambles for alternatives. U.S. silver stabilizes at $125 to $135. If Greenland announces alignment with China, U.S. silver spikes to $145 to $165 as American industries panic. Chinese silver stabilizes. If Greenland announces they're accepting investment from both, but not committing exclusively to either, both markets spike to $135 to $155 simultaneously. By February 16th, we're living in a new reality where silver is no longer a sub-$100 commodity. It's a $125 to $155 strategic asset. COMEX has lost credibility as the global price setter. We now have regional pricing with restricted flows between markets. That's my forecast. That's what I'm preparing for. Now, I can't prove this, but I have a theory about the timing of the USGS report that I want to share. What if the USGS has known about this deposit for years and the data was deliberately held until now for maximum strategic impact? Look at the timeline. Core samples collected June to October 2025. Analysis completed November 2025. Report published January 17, 2026, the exact same week as Trump's Greenland push and the Denmark tariffs. That timing is too perfect to be coincidence. My theory: the Trump administration told the USGS to hold the data until mid-January and release it at the moment of maximum strategic impact. Why? First, it justifies the Greenland offer to skeptical Americans in Congress. You're not buying Greenland for ego. You're securing 2 billion ounces of strategic minerals for national security. Second, it applies maximum pressure on Denmark by showing that Greenland is far more valuable than Denmark realized. Third, it forces China to show their hand. If China counterbids, it confirms they view Greenland as strategically critical. If they don't counterbid, the US wins by default. Fourth, it spikes the silver price, which benefits US mining companies and punishes short sellers, many of whom are foreign banks. I can't prove this coordination happened, but when you look at the timeline and the strategic logic, it makes perfect sense. If I'm right, it means the Trump administration is playing a far more sophisticated geopolitical game than the media gives them credit for. One more angle I need to address: Russia. Russia has the largest Arctic coastline of any country. They have massive military infrastructure in the Arctic. They view Arctic dominance as a core strategic interest, and they're watching this US-China competition over Greenland very carefully. If the US wins, NATO's position in the Arctic strengthens dramatically. It encircles Russia from another direction. Russia won't like that. If China wins, it brings Chinese military and economic presence to Russia's western Arctic flank. Russia might not like that either. Russia's best-case scenario is probably a stalemate where neither the US nor China gains full control. Russia might actively work to create that chaos by funding Greenlandic independence movements, providing intelligence to Denmark to help them resist US and Chinese pressure, offering their own smaller investment package to complicate negotiations, or using their UN Security Council veto to block international recognition of Greenland's independence if it's done under US or Chinese auspices. Russia has tools to complicate this situation. And a complicated, uncertain situation keeps silver prices elevated because uncertainty gets priced in. Let me bring all of this together. The USGS just revealed a 2.03 billion ounce silver deposit in Greenland, the largest undeveloped deposit in the Western Hemisphere. Trump's Greenland acquisition attempt is directly tied to securing this strategic resource for American interests. China is counterbidding with $300 billion to block US access. Denmark and Greenland are caught in a superpower competition. The global silver market is facing a 500 million ounce annual deficit by 2030. Greenland controls 20% to 25% of potential future supply. COMEX paper silver at $95 is increasingly meaningless. Physical silver in the US trades at $105 to $113. Physical silver in the Arctic trades at $137. We're seeing 15% to 44% premiums over paper. This market fragmentation is here. This validates everything. Silver is strategic, not just a commodity. Supply is constrained, demand is exploding, geopolitics is weaponizing access. My personal strategy: hold all physical silver with a target of $120 to $140 within 6 months. Watch for mining stock opportunities if we see pullbacks. Allocate small percentage to Arctic exploration juniors as lottery tickets. Monitor negotiations daily. Prepare for extreme volatility. The media is laughing about Greenland. The Pentagon is strategizing. The Chinese Communist Party is mobilizing. If you're watching this, you understand the reality. This is not a joke. This is the beginning of an Arctic resource war. Silver is the prize. Today is January 20th, 2026. Silver is at $95 and climbing. The trap has been set, the game has begun, and the next 6 months will define the silver market for the next decade. Stay sharp, hold your silver, and watch what happens next.